Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
Well, hello, everyone. Welcome to the Millionaire Next Door podcast. Thank you again for being here. We like to delve into a lot of different conversations. I call them conversations that matter. Today, we have a guest who's going to talk about a life settlement. What is that? We're going to focus on insurance here, and I'll introduce him in just a second. Anybody with any ideas or anybody who'd really like to hear a topic covered, please direct message me or let me know. I would love to take that on. We just 2 episodes had an Olympic skier on talking about fear. That was just completely awesome. So without further ado, we're going to talk about life insurance today. So that should be almost as exciting as the extreme skier that we dealt with. I'd like to welcome Rob Haynie. He is my guest today. He's the managing director of life insurance settlements. You're out of Florida, you were telling us, and I want you to introduce yourself. Tell us, just launch into what you want to share with us.
Sure. Thanks, Robert.
Yeah.
So my name is Rob Haynie. And as Robert mentioned, I'm the managing director of a company called Life Insurance Settlements, Inc. And a life settlement is something that people utilize when they get to the end of the usefulness of an existing insurance policy. Someone that might be in their 60s, 70s, who has used that life insurance policy for the past 30 years for protection or whatever other means they bought the life insurance policy was in the beginning. And they want to know if there is an exit plan. So my goal has been for the last 31 years to educate people like Robert and others across the globe about what you can do if a client comes to you with a life insurance policy that they no longer want, they no longer need, or can no longer afford. And then we offer them what's called a non-binding, no-cost free appraisal. What does that mean? So we represent the seller. So for example, I'll use you, Robert. You have a client that comes to you with a $5 million life insurance policy that he took out when he was 38 years old. Now he's 72. And he no longer wants it anymore. The premiums are getting expensive, and all the reasons he took it out, such as protection on the home, fact of income replacement, kids' college funds, et cetera, have gone. And he no longer wishes to pay those premiums. So he can surrender that policy. We'll just make this one up for $125,000. He's been using some of the cash for that matter to pay the premiums. So you bring him to someone like myself, and I go out to the marketplace as a representative and put different types of entities that buy life insurance policies into the uncomfortable position of being in a bidding war. So they're going to bid against each other to try and buy that policy. And the question is, why would somebody bid on someone's life insurance policy? Well, they're going to do 2 things. They're going to look at the cost of insurance on that policy going forward and couple that with a life expectancy projection that they're comfortable with. And if those numbers align, they'll make an offer, obviously greater than the cash surrender value, but certainly less than the death benefit. And if it's something that's acceptable, they'll move forward and transfer that policy over to the new buyer, and they'll take that cash. And last year, the average was 6.2 times greater than cash, and utilize that, give it to somebody like yourself who puts them in a better position financially by giving them a product that's working for them as opposed to against them. And it's their decision. It's not something they have to do. It's just as good to have it. Someone like yourself can align that with their other options, surrender, loan, et cetera, and determine what's best for them. That's it.
Yeah, that's good. Let me just back up to delve down a little bit. I did want to ask you to get a general sense of the multiple on the typical multiples. I'm sure there's different variables. You mentioned 6.2 or let's take a face value of 100,000, a million. Is there some typical, or how does it work? Just to give folks, what do we? Yeah.
So great question. I'm on the board of LISA, which is Life Insurance Settlement Association, which represents about 98% of the market that exists in the secondary phase of it. And we every year run a data call where we ask for data points from providers, which are the groups that buy the policies, such as what is the death benefit that you bought total? What is the cash surrender value total? What is the amount you paid to the client total? And then more importantly, what does that look like as a representation of cash versus settlement? So the first year we did it, so in 2021, it came back 7.8 times more. And then this year was 6.2. Last year was 6.5. So the bottom line is we've had, I mean, I'll give you an extreme example. Sometimes we beat the cash surrender value by $10,000. It's still $10,000. Other times we beat it by several $1,000,000. So it's just a function of, again, the life expectancy. So it doesn't matter the face per se. It just matters on what those two things I talked about a little earlier, which is the alignment of what is the LA and what is the cost of insurance going forward. Keep in mind, they're going to pay as little as possible to keep the death benefit level. So the reason I tell people this is it's hard to pinpoint it because people see things differently. So there's one buyer that's going to look at somebody's policy and go, that individual's got 6 years left to live. And the rest of the market's going to say they've got 12 years to live. So obviously the one with 6 years is probably going to be the highest offer. And then they're going to be not just buying that one policy, they're going to be buying hundreds, if not thousands of policies and put them into a pool as an investment pool. So we tell people, let's go look at it and let's see what in fact we're dealing with. Because we've had a guy, I'll give you an extreme example, but it's a good one for the purposes of this podcast. A broker dealer that will remain nameless rolled out life settlements 6 years ago. They told everybody in there that's underneath them that this is something they should be looking at if the client comes to them and says, I've got a policy I don't want, I don't need, I can't afford. So I've been to these meetings. Others have been to this meeting. There's been webinars, advertisements, et cetera, coming across all the different channels at this broker dealer. And a RIA decided when his client came to him that he had I think it was $118,000 of cash surrender value. What are his options? And the guy said, too busy to deal with the settlements. That's a great thing, just to surrender it. I think it's about 2 weeks later, he saw a television ad on TV, called that ad and found that he could have gotten 1.6 million. So that's why I say it's always a good idea to investigate. Problem was, broker dealer did his job. The RA didn't. He's no longer with the firm, and the E&O coverage paid out about $2 million to the client that could have gotten that solved 2 weeks earlier. So I'm not here to scare anybody. I know if you're working with clients and they can surrender a policy for $118,000, or they can sell it for $1.6 million. I think as their representative, you'd want to be working with 1.6 million versus 118. And I think you can do some wonderful things for that client and make them very, very happy.
Good to know. There's nothing left on a term policy. Is there, do those even
Great question.
factor into this?
There is, which I mentioned 60s in my introduction. So someone who's 60 typically is going to have a longer life expectancy than someone that's 75. That's pretty obvious. But they have something unique when they have a term policy. They have a conversion privilege that's getting ready to expire around age 70. So because that conversion option exists, buyers look at that as a way to manufacture an offer out of the conversion commission. So what happens there is they'll say, okay, we're going to give you, we'll make it up, $1 million term policy. We're going to give you $15,000. That's it. And they're going to buy the policy from you at age 65. And they're going to continue to make those premium payments, and they're going to convert that policy to a UL, and they're going to continue to make those premium payments until that individual passes away. But out of that, what happens is there's that conversion commission that I talked about. That's partially how that $15,000 was earned. In some cases, they will let us participate in the conversion. So that means you yourself, myself, and maybe even in some cases, the client gets additional capital that way. And people say, well, who's going to sell their policy for $15,000 if it's $1 million? I go, the person that was getting ready to surrender, let it lapse for zero. So That's why we talk about that. And that's news. That's a great question, Robert. You asked me that question 5 years ago. I don't think I would have given you that answer. So that's something that these investors have looked at and said they like the play of a longer life expectancy. And as one of my good friends who runs a fund overseas said, some of my investors like to buy the policy ahead of the impairment. So they know the impairment's coming based upon what they've looked at, but they don't want to pay for it now. They want to maybe pay for it later. Probably to interest to you and your listeners is there's a tertiary market that exists. So as these policies are sold down the road, they may be sold again. So if someone buys someone that doesn't have anything wrong with them, then all of a sudden 5 years later, they certainly haven't passed away, but they got a whole host of medical issues. That life expectancy went down, that policy is worth more, and they can sell that policy and move on to another investment.
Okay. Yeah, I'm sure insurance companies, they have different portfolios, or some want this risk versus others. So they might have more of an appetite for one type of situation versus someone else. And you help give folks an overview, and this is a great resource. I mean, a lot of what we do, in our practice, our core is managing money. We are an RIA firm, a fiduciary, registered investment advisor, full fiduciary, but it's often all these other holistic elements that we can bring to the table. I have what I call a value-added resource team, VAST. So, having someone walk through this process and introduce you and just run through it. And let's say worst case scenario, it's worth zero. Nobody has an appetite. The value on this thing has expired. Too bad. But you know what? Here you can just get a number, an opinion. You can have someone review it with the experience who knows the market. And I think that's really valuable for a lot of folks. So yeah, keep going. I don't know if you want to.
Well, I'll add to that what you just said there. So I have guys that call me up with people that are in their 50s and they send them to me. You know what they want? They want a declination letter they can put in the file. They don't want to be like that guy who told to take the 118 and find out he could have got 16, which is fine with us. We'll go out. We'll say, okay, here's a 56-year-old. He just won the 10K in his hometown for the 5th year in a row. He has got eczema. What do you think? And they'll be like, no one's going to buy his policy. I said, could you decline that? And he puts it in his file, literally. So the client never says, well, why didn't you look at a life settlement for me? I saw this ad on TV. A lot of people don't know what it is. So what I'll add to this, the really most important thing is we bought as an industry, not just my firm, but all of us collectively last year, they bought just underneath $5 billion of death benefit. Last year in the United States of America, we backed into these resources because we can't find any other way to do it because their ACLI is not going to give it to us. 112 billion was lapsed or surrendered for people over the age of 65. So we bought 5 billion on top of that. So when you talk about an opportunity that exists, and there's a lot of people, the lack of education, which is on us, we have not done a good enough job, obviously. There's so many people that have no idea that their life insurance policy is an asset just like their home. They have no idea that they can sell it to whoever they want.
Right. Okay. Well, that's good to know. And then you mentioned on one of the questions 5 years ago, it might have been different. I suspect things are evolving in this or changing or what?
Yes. So buyers come into the marketplace. So we talk about changes. So I mentioned my friend, his name's Jose Garcia. Company's called Carlisle. They're based out of Luxembourg. They just were bought by Abacus, which is a large company in our business. They were inviting investors, mainly European investors, to a conference that they've had for the last 15 years in Geneva every October. And I went almost one of the first ones, maybe the 5 years after they began, and there might have been 50 people in the room. Most of the investors were people with funds that wanted to invest in alternative assets. But then pension funds started to show up. And once the pension funds started to show up, the LALEs went out longer. Because a pension fund, when you think about that type of investor, their liquidity needs are way off into the distance. They don't need them tomorrow. They don't need them next year. So they're required by European law, and I think that extends here to the States in some respects, to diversify their holdings. So they got to buy alternative assets. The reason they like the life settlement asset, now they're not buying a whole bunch of it, comparatively speaking, to everything else they buy. But the reason they like life settlements is it's uncorrelated. Meaning, if the market goes down, I saw today we're down 900 points, maybe longer since we started this podcast. that kind of stuff happens, your life expectancy doesn't change, the death benefit doesn't change. It stays stable. So they like that, to have that in their portfolio, given that there's all these other things that could happen and all these other
Mhm.
investments.
Yeah.
So that's when I began to see it safe. So we're talking about a life expectancy in 2010 might have been 6 to 8 years. And now we're talking 20 to 25 years. So I don't think we're going to see 30, 35. I don't, because there's so much opportunity that it still exists that we haven't even began to uncover for people over the age of 65. But there's a lot of people in this business, unlike yourself, who don't talk about life settlements because they don't want to, or they're told not to. Carriers, for example, New York Life will prohibit a New York Life agent
Ah,
from even talking about life settlements.
right.
And there's a
Interesting.
lot of broker dealers that won't talk about life settlements. I don't know if it's they're afraid of them or it's just that they see it as too much work. But I think that's foolish, given that you're unearthing capital that really didn't exist, wasn't on the balance sheet to begin with, that you can now utilize and put to work in something else. So one of the most common things, and I'm sure a gentleman like yourself could think of 1,000 things besides this, but annuities. They literally take the money and they dump it into a SPIA. They go from paying out money for a life insurance policy to receiving money that they either take or continue to reinvest inside that annuity. And I believe that the annuity pays a commission when they sell it. So you're taking an event that people are throwing away the life insurance policy, whether it's cash surrender or
Mhm.
lapse, and now you're buying them a product that you're actually getting paid commission to do so. So it's kind of foolish.
Yeah, some of these portfolios may invest in the repurchase or buying these policies for reasons you don't understand. There is a value. They understand that value. They're sophisticated. They're not going to give you some wild price. They're going to know in a pretty tight margin. But what you're presenting here is a process to help determine that, ferret that out, and then literally get you paid or get you dollars for something you might just totally be leaving on the table. So I think that's a very valuable process that's worth having someone go through that exercise without a lot of expectations. I mean, you understand it, you understand the multiples there, but you see what it is. And that's terrific that you do that. And that's good to know.
Yeah. I mean, so I started in 1993. So back then there was absolutely no regulation. And if there was, it regulated
Mm.
what's called vertical settlements, which was somebody, which
Hmm.
still exists, by the way. It's somebody
Yeah.
who has a life expectancy of 24 months or less. Now we live in a world where 45 of the states in some way, shape, or form regulate this activity. We, as a member of LISA, practice, we make believe all 50 states have regulations. So we use the NAIC Model Act guidance, the contracts, if you will, that mimic the other states. So there's protections. So protections for the consumer, such as one of your clients, Roberts, goes through the whole thing, gets their capital, is driving down Pacific Coast Highway and says to himself, you know what? I really want that life insurance policy. I don't like the fact that I've sold it. If it's within 15 days, we'll unwind the
Mm.
transaction, get the policy back. Another thing I like to say, which is kind of bragging, but it's kind of unique, and it's a really simple explanation why this is so. As an industry, again, we have zero consumer complaints in the last 5 years. You know why? Nobody ever complains about getting more money.
Right.
So we like to give people an option. Again, there's
Hmm.
nothing incumbent upon them that they have to take the offer. They don't. And we've even made some other changes. We're talking about this a little earlier. So we've now allowed people to break policies into smaller sections. So if they have a $10 million policy, we can break it into 2 5s. They can keep 5, they can sell 5. We can also do what's called a retained death benefit. And that's even a little more unique in the sense that they can say, okay, I don't really want to pay for insurance, but I wish I had a little. So $5 million policy comes to bear, and they see something and say, okay, we'll give you $500,000 retained death benefit. We'll change it at the carrier level, put your name beneficiary on there. And when you pass away, they'll get $500,000. That could be another form of an offer. So instead of cash, they get retained death benefit. So the market is making changes because as more capital comes in, it's very competitive in what I call a typical vanilla life settlement, somebody with a life expectancy of maybe 5 years to 10 years, where every buyer wants that policy. They're all going to want it. But depending upon the restrictions and the requirements of the fund, they're not going to be able to compete with everybody. So they have to kind of create these little pockets where they can compete. So that's why you're seeing some people buy longer life expectancy. There are still people that specialize in a viatical settlement, which will go
Mhm.
through the process and tell the client, okay, on your $1 million policy, they want to give you $625,000. First thing we'll do with your help is tell them not to take it. Because if someone's going to give them that much money, they don't have much time to live. And it's better to wait to get the full million for your family. But
Mhm.
in the rare circumstance that they don't have the money and they're literally going to lapse the policy because they don't have the capital to keep it going, then we're going to want to sell it.
Well, this is a great resource. I mean, I've been doing comprehensive financial planning for 27, 28 years now. Where our area of expertise is very deep is in the investment management. We're an RIA. We really know that. We really deal with all areas of comprehensive financial planning, including insurance. But I never bill myself out as a specialist. I know a lot about this, but we always engage very specialized folks who really understand it on a deep level, whether it's long-term care, something like this, if it was a viatical settlement, if it's some type of insurance for estate planning purposes. There's a lot of nuances. It's a very dynamic field and you need specialists. And so we would partner, but we would be there to help guide the folks and say, hey, this makes good sense. What we call a sounding board process, to have that, to facilitate that conversation, to help educate them and see if it's something that's reasonable or let them know. So this is a really, really great resource. And we will put a link in the show notes. And if this does ring a bell for anyone, or this seems like an area, reach out to me. I can get Rob this info. He can walk through the process, educate you. And it is what it is. These insurance companies are not foolish. They know what they're dealing with and what the value is, and they'll probably they're in business to make a buck. But if you have value there, he can pit these folks against one another to find out where the best deal is, and that's a really valuable resource. What else? We don't need to go too deep down the rabbit hole, because I just want to let folks know this is an option and we have a solution or someone who can help them through that process. But what other thoughts would you like to impart upon us?
Well, echo what you just said, which is I like the term sounding board. So obviously, our goal is to be your back office,
Mm-hmm.
Robert, for
Mm-hmm.
settlement. So your client comes to you. We're not talking to your client. We're talking to you and
Okay.
giving you all the information necessary. If you bring us in, and we've been brought in many times before to explain it, we do that as well. But they don't know me. They know you.
Okay.
So
Great.
we want them to work with you, understanding that you're going to only do what's in their best interest as their fiduciary to get them the best offer or to make the best decision for them. It may not be that selling their policy is the best. They may need insurance. Actually, when people investigate life settlements, they find out all kinds of things about their clients, like A, they don't have enough insurance, or they have too many annuities, or they're overpaying, or they have a policy that you didn't even know they had that they bought 35 years ago from another agent. So those are things that we're trying to get people to understand is when you do your annual reviews, and it sounds like your firm probably does more than an annual review with their clients, you kind of want to know their overall financial health, what their holdings
Mm-hmm.
are. And if they've got a policy out there that they haven't told you about, and they're sinking premiums into basically a sinking ship, we want to get
Yep.
them out of there and use those funds for something that's more purposeful.
But that is just great. I think this is a terrific resource. So if this rings true for anyone, we do have a lot of clients who listen to this. We have people all over the world, but reach out. We'll engage Rob in that process, walk them through. You don't even really have to think about it. We'll do all the thinking about it and help get you that information. And that's something we'll offer as a value-added resource for our clients, our time and his time to really think this through. And there's a value there or there isn't, or we'll ferret that out. I mean, I'm familiar with viatical settlements. It's come up over the years. I have never dealt with a single one in 28 years. So rather than trying to get in there and understand that, we can go through a process with someone who has probably dealt with hundreds, thousands, maybe tens of thousands of these cases. It's not his first rodeo on this. And we just think there's a lot of value. I don't know if it's going to come up a lot for folks, but maybe a couple times a year. This is terrific. And a huge part of this podcast and why I started it is to really delve into these types of topics and we're just getting so much good information. You know, we have a very developed and refined and optimized process. We call it our process. It's objective, unemotional, rules-based. We walk people through that. They don't really understand the depths of all that. And it's very evolved. We have developed it over 27, 28 years. The point is, we're not just satisfied with that process. We're always trying to make it somewhat better, improve it, enhance it. I think this is terrific with respect to that. Here's something, if and when it comes up, as life evolves, as needs come into that might not have been there 5 years ago or now there, we can review that, get you some really qualified view of that, see if there's some value there. And this has been a terrific education, and you're a terrific resource, and they can just deal with me. But that's great to know. I now have a back office on that. So I thank you.
Well, it's my pleasure. I mean, I say something that we've said a long time, we're kind of putting life back into life insurance, because a lot of people don't realize that people think of life insurance and a lot of people think of it as death insurance, right? You got to die to get it. And we're like, well, why wouldn't you? I mean, you've used it all these years. So it's not like you've wasted your money. You've protected yourself, but at some point that ends. What's next? And is it, I take the money out of the life insurance policy and I give it to Robert. Robert buys me one thing, two things, a couple of things. It makes my life even better. That's the goal.
Robert, that was a great conversation. And I really appreciate listening to it. But I know it's going to be one of those things where it makes absolute sense while you're talking about it. And then I want to share the information with someone and I can't articulate it. How can I make it simple for them and make it simple for me to remember?
Patrice, a great question. We ask it all the time. And the way I try and explain it is that you're going to get on offer a free non-binding appraisal of your life insurance policy. So when you think about your life insurance policy, I want you to pretend that it's your home. If you're going to sell your home, you're going to get that appraised. If you're going to sell your art, you're going to get that appraised. If you're going to sell an antique car, you're going to get that appraised. So this is no different. We're going to go out with Robert's help and get the policy appraised by as many different entities as we can, get the highest market offer possible. And then we're going to present that to you, and you'll make a decision as to what the best move is with Robert's guidance. That would be the best way I talk about it.
All right. Just like getting your house appraised. That's a great analogy. All right. Well, Robert, you want to take us on home?
Yeah, thank you so much for listening. I hope this has been of value. We're going to continue to find other topics and items that come up that we can share with you and that take you a little deeper under the surface of our practice, some of the things we're doing for folks. If you enjoyed this, please like it, share it, and thank you so much again for listening and staying tuned. And let us know if you have any ideas or things you'd like to hear about. We appreciate you spending your time with us, and make it a great day.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC-registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities LLC, member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.
All investing involves risk. Past performance does not indicate future results. Specific products discussed are not suitable for all investors.